Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Friday, January 31st, 2020. As we head into the last trading day of the month here, let's take a quick look at the charts. I figured it's a good time to do a video. There's some things I think are definitely worth pointing out. We're at a pretty key technical juncture. If you're listening to this, you probably already saw the charts I posted just a little while ago with that post titled Stock Indexes Testing Key Support. So we'll go over those real quick, and I just want to share my thoughts, what goes into deciding how to be positioned here and what to do going forward. So first of all, we have this trend line here that on the Qs right here comes off the October 3rd lows. Pretty important trend line. We hit it the other day and we're testing it again today. Pretty big reversal today intraday. And again, as I like to say, support is support until unless broken. Nothing's really changed on my views in the last couple of weeks, especially since we had those sell signals a week ago today, Friday. We broke down, and you can see when you look at the daily chart, it's pretty clear. I gave you, bounce targets on the 60-minute, but what I'm doing here is looking at the top of the gap there, pretty much the bottom of the body of that candle, and that's where we bounce back to, and you can see QQQ failed to get above there. Now, it's not over yet. We're at a key technical juncture, and so, we're either going to rally from here or break down. As I shared my thoughts earlier, and I maintain that as of right now, I still think, odds favor a bounce. I wouldn't, well, the only thing I would say is be flexible. And what I was trying to say is if you're not an active trader, don't try to game these bounces. Remember, this market has been a one-sided market, meaning overly bullish, a lot of longs, shorts being blown out. So when the dam finally breaks, what I mean by that is when you finally get a good sell signal. Remember, this was a 60-minute sell signal on the 60-minute charts. Yeah, that trend line showed through on the daily. You can look at it that way as well. But it's a short-term trend line, and that means short-term correction. This is a longer-term trend line, so that would indicate a deeper correction if and when this trend line is taken out with conviction. So let's look at a few other things, and how you trade it, it's up to you. Remember, it's a Friday, so if you take any positions today, or if you have any, you're gonna have to you have to decide whether to take them home, and you have an extra 2 days of overnight risk versus just the 1 day during the week. So there's a consideration to make. I've made my thoughts clear on where I think we're going, and I think the risk reward's favorable, but I'm still at that, keeping it light right now because we need to get those more powerful sell signals to help solidify the bearish case. Today's price action certainly helps to see, that nice reversal. You can see it right here on QQQ. There was Friday's close. This is a 1-minute chart. Popped at the open. We even went higher in pre-market. If I put on the pre-market trades here, you can see how high we went there outside of normal hours. Always, there it is. So right there, yeah, there's a 1-minute chart. So there's Amazon right there, what it did to the Qs after hours. And you can see a lot of that was faded, and now all of that and yesterday's gains are faded as of now. All right, let's just finish up here on the 60-minute charts. This is the board, the same one I showed you in that post earlier today. It's the same trend line that I just showed on the daily chart as well, starting in this video at the beginning of the video. There it comes off the October 3rd trend line, so or October 3rd lows. And that's it. So trend indicator remains bearish on the 60-minute time frame, but I still favor a bounce. Don't follow what I do on an active trader. By the time I get these videos out, or I can change my mind on a dime, close that out. But I covered my shorts, my NQ shorts, in the active trading account and went long for a bounce, and I still think we're going to get one here. At least that's what I favor a bounce. And how far it goes, I gave you some potential bounce targets. We'll get to those in a second. Here, let's look. ES, for example, when I gave you that post, we were at the 32.32 level, and actually that's where we're at now, 32.35. Slight dip below, but we still on the 60-minute basis. When I say that, it means a candlestick. This is a 60-minute chart, so these 60-minute candles are still yet to print a solid close, or any close actually, down below there. So that's still a successful defense of that 32.32 support. I think it's for active traders, an objective long. You have a stop somewhat below. If the floodgates break, you'll probably know it. It probably will be impulsive, but still think we can get a bounce. And look, there's some resistance right here. I can add a line. if you're an active trader and you're trying to, day trade off the charts and game a quick bounce, you should, know which levels. You probably know what you're doing and look at the levels here. You can use a 5-minute chart, a 15-minute chart. This is a 60. And I think at most probably come up here and back test that trend line from above. So I'm kind of staying flexible today. I may, by the time you even get this, listen to this video, by the time it's posted and published, who knows? Maybe I'm short again. Let's go to the 60-minute chart of NQ. Again, this was ES right here, the S&P 500 E-minis. Let me put that back to where it needs to be. Drag this one out a little bit, and there it is. You can see the trend line on ES was violated briefly right here, but as I told you, I think it's all about the market-leading FAANG stocks. I definitely take this into consideration, don't get me wrong. For example, as I posted on this morning, although NQ looked pretty strong, ES had rallied right back to a very solid resistance level, about 3,300 right there, 32.98, round that up. And you can see that was this whole topping little consolidation area there. You had it resistance right here, and then once that level broke, you had the impulsive drop. That's where your sell signal was triggered, and we came and back tested a few times and failed. So that's where we're at. Testing some pretty important resistance. Let's go to the NQ 60-minute chart. Again, this was and is the most important trend line right here on NQ. I think that uptrend line. Here I have it coming off the early December lows, but it's the same one I just showed you a minute ago that goes back farther on QQQ. So that's it. We had a nice leg down. We're at support. Remember, when you have a near vertical fall like that, it is more than common to have what I call momentum fueled overshoot. That's where, if we zoom in real tight, you can overshoot the level. So it gets kind of tricky. When is it a break of that and when not? Is it just a 60-minute close? Is it right here? Is it a powerful candlestick? As I like to say, the redder the better. If you see a solid red candle come down through here, even if it hasn't finalized on the 60-minute candle yet, meaning printed at the end of the hour, but it's down here, you're probably not going to snap back up all the way up here if there's only 5, 10, maybe even 15 minutes left in the session. It's possible. You also have some horizontal support levels that could come into play. But what I like to look at too in determining whether we're going to get a whipsaw signal if we do break below there, or if that's going to be the the next more powerful sell signal, is I like to look at the FAANG stocks, the leading components of both the NASDAQ 100 as well as the S&P 500. So let's do that here. Let's start with Apple. Here's Apple. Nothing's changed. I've covered this quite a bit recently. Blowout quarter. And of course, the market's at all-time highs. Things have been strong. So but what have they done since earnings? Well, they're fading it pretty hard today, down about 3%. But look, bigger picture, we're still right off all-time highs, and I'm not waffling at all. I think Apple's poised for correction so far. It's playing out almost to a T, as it should. We had an impulsive breakdown, back test. Yes, it was in front of earnings, but after earnings, there's the earnings ramp, post-earnings ramp, and they're fading that. And if you back out everything, forget about what happened with earnings, just look at this from a pure technical or charting perspective. You take it on face value, unless this pattern is, violated or voided. You have a breakdown, an impulsive breakdown, a back test, and a rejection off the top of the wedge. It back tested near the apex of the wedge. You had negative divergence at this high, but you also had it here when it extended that divergence right here. You can see. So, it doesn't get much better than that. It doesn't guarantee it'll play out, but I would say at minimum we're going to come down here and hit my 300-ish target as well as that longer-term uptrend line. And now near-term stuff, what I need to look for is support on Apple. What support level is likely to produce a reaction next? And that is right there, about 32.16. From where we're at right now, that gives me a little more downside, about 0.8%. And that's a pretty decent near-term support level. You can see, maybe you don't, it's in my, clear in my mind, at least the levels I see. It doesn't guarantee it'll hold, but I can tell you it's support. You have a gap right here, reactions from above, reactions from below, reactions from above, quite a few reactions from below. And so therefore that should produce a bounce or come into act as support on Apple. If it doesn't, and this is the tricky part right here, Again, as I said in the beginning of the video, this has been a very one-sided rally with hardly any givebacks or corrections, extreme bullishness. And what happens is, after such an extended period of time, you have more and more longs, fewer and fewer shorts that get blown out. People are on margin, thinking the market's going to go up forever. And then what happens is, when the dam finally breaks, meaning the tide changes, support levels are broken, you can get a rush for the exits as a crowded trade tries to unwind, meaning everybody's trying to sell at once. All the people that have been riding Apple and high-fiving themselves, said, okay, it's getting a little risk lofty, and it's done this before, and so I'm going to set a stop loss. Well, think about that. If everybody in the stock, not everybody, but a lot of people have stop losses that if it drops 5%, all those stops start to get hit. And that's where you get those pretty quick downdrafts. Selling begets more selling as more stops get hit, more longs pull the trigger to get out, shorts start to pile in. We're not there yet, but it's somewhere in here. And like I said, right now, let's just look for a pullback to that 300 level. That's what I think is likely. When will that be even more likely? Well, when the recent lows are taken out right here, these lows. So that's it. Yeah, I've given you, first support level, not too far below. Of course, you have recent reaction lows, and there's a gap right there. There should be a line right there as well. That's support. But again, I'm favoring a move down to here if that happens. All right, so that's Apple. Let's look at the rest real quick. Try to gauge, where this, whether we're going to bounce here or not. Here's Microsoft, 60-minute chart. Microsoft has been working its way up in the top of the channel. As I said yesterday, it was an objective short at the top of the channel, just as it was here. Anytime you have a security trading in a price channel, ideally, if you're going to trade the channel, you want to go be long at the bottom of the channel and either taking profits or going short at the top of the channel. And that's where we're at right now. First support comes in right there. You have a gap. Technically speaking, the bottom of the gap is right where we closed the day before, which would be 168.18. But you have a top of a candle there. It's a little bit higher there. So we'll call it about 168.80, and that would be support. Let's measure that out. And that's about 0.84%. Comes in right around where that support on Apple comes in, about an eighth of a tenth. Oh, guys, sorry, 0.8 of a percent lower. And you can see after that, probably the trend line here. Trend line's been violated once. Channel's getting old. If we take that out, we're probably just going to break the channel. And again, you can see supports down here. All right, let's look at a few more. Alphabet coming up on support right now. They will be the last of the FAANGs to report. I think it's on Tuesday, February 3rd, next week. Support coming up right just below here at about 147.27, and then you have the trend line right here. Zoom out, show you that trend line if you want to replicate it. Again, comes off. That's a pretty pivotal low right there, October 3rd. That's where a lot of these indexes and a lot of stocks pick up a nice clean trend line, and that is support where we're likely to get a reaction. So an Alphabet, if and when it takes that out, that would be your first support. And then if that breaks, your next support's down here about 136.84. So Amazon, they just reported big gap up, holding up so far. It's given back some of the gains after hours and all that. Of course, it's going to be it's indexed. It's part of the NASDAQ 100 as well. And but you can see it's a pretty significant resistance. What I'm doing here is rolling out on the daily time frame, and let's take everything away, and plain and simple, what I see is a potential triple top. Whether it breaks above this level or not, if it reverses, that would be 1, 2, 3. 3 failures. If it fails here, of course, it hasn't done so yet, around that 2032 level. You can say what you want about where you think it's going. You're going to be right or wrong, as I will. But what you can't argue is the fact that this is resistance. That is certainly resistance. We have actually 2 failures there, a third right there, and we're testing that level again. So a key level for Amazon, and support It depends. Amazon's been kind of grinding, chopping around all year. Here's 2019, the year, after the initial rally. Once things stabilized, it got up here back in March, and this has been the trading range. So I know I just made a mess of it there, but I think you can see what I'm going for. And that's also would probably be what I'd use as a to project a measured target should, quote unquote, should Amazon fail here slightly above and then fall back in there for a triple top. A triple top pattern on a stock or an index or whatever security you're trading, what you want to look for is a topping range or trading range like this. And then the measured target for a triple top pattern is the distance of the range from top to bottom, which I measure there, added to the bottom of the range if you get a breakout. So really a sell signal doesn't come. You could short it here with a stop somewhat above if you expect it to reverse, but a longer term sell signal would come on a break of the bottom of the range here, and then you would take your measured target. I'm just going to eyeball it here, it's not an exact estimate, and that would give you your measured target on Amazon, if indeed you get a triple top pattern. So something to watch for. The other thing to watch for is, let's say the markets were to gap down on Monday after the weekend here, you have a potential for an island top candlestick. This is an island top can come on a single candlestick like this. If we were to gap down below that candle on Monday, let's say like this, an island is separated by a gap on both sides. Here's a gap, today's gap, and again Monday if we gap down, and depending on the size of that gap, that leaves this to be a potential for an island top. It's not there yet. Work to be done, and that's why I'm still being a little cautious and probably will be going into the weekend. We'll see what happens today. Like I said, I'm looking for a bounce right now intraday, and most likely, almost certainly, I'll be back short before the close today for swing trades. And I have some mild swing short exposure in my accounts, longer term accounts, IRAs, things like that. All right, so that's Amazon, what to watch for. And as far as supports, like today, nothing much really, because we're gapped up and we don't have any support until you get all the way down here. So there's a big gap to be backfilled on Amazon, and we'll see which way that. Alphabet, I already showed you the Class A shares with the L at the end. This is GOOG, the other share class. There's your support and trendline support below. Of course, quite bearish if that breaks. But again, guys, I like to collectively look at all of these. And it's not just if one of them breaks down or one of them hits support. If you have multiple FAANG stocks all coming up on support at around the same time, the initial tag, I like to say it's the initial tag of support from above. It's usually where you get a reaction. Or even if it doesn't have to be the initial. We had it back here, a tag. It wasn't very well defined. It was mild support there. So that gave me a pretty good reaction, and that's why I think we'll get one more here on that bounce. But I've traded long enough to know this market has a lot of pent up excesses in it, and at times like that you can just smash right on through resistance levels if we get that trigger, that rush for the exit. So again, you got to be quick if you're trying to game these bounces, and if you're not an active trader, I can only tell you what I'm doing on my, I wear different hats. I wear day trader, active trader hat. I wear a swing trader, investor hat. I have different accounts with different objectives. IRAs I don't trade day trade in, don't trade actively in. Those are more swing trading accounts. And for that, like I said, everything that I'm seeing so far is market's playing out over the last week since we got those sell signals a week ago today on Friday, playing out as expected, almost exactly as expected. So that helps to at least help solidify that near-term case that I'm looking at, the near-term bearish case, but still a little work to be done. And then if that work is done, in the other words, the QQQ and SPY and ES and NQ and some of these FAANG stocks, we start breaking these supports, then I will look to add to those short positions if I think there's going to be more downside. So that's it. Like I said, a little work to be done. A lot of these stocks are still well above some decent supports and not too far off their highs. So you can't write this market off yet for anything more than just another. Hard to say right now. You can see I don't know the percentage terms for the drop, but my near-term target here, I'll tell you. Again, I've covered it here. QQQ, top of the target zone. minimum is 216.18 or so, about 211.42 on to the bottom of the zone. If this trend line breaks, I'm going to say that, then I think that opens the door up, increases the likelihood this 211.42 target's hit. And if you want to know how much that is, that would be from where we're at now, about another 4% drop. And as I said, if that does happen, that also then triggers some, potentially longer term sell signals, because it's going to take this trend line out, it's going to confirm these divergences, everything else, and then I may turn my focus to the daily chart and decide whether to extend those targets, those swing targets. And of course, there's Facebook, another one of the FAANG stocks. That's when the market didn't like what Facebook had to say, certainly didn't. And again, it's just, to me, a beautiful display of technical analysis. There was earnings coming up, and sure, they certainly were the catalyst. That's what I was saying before this week even started. That look, if we're going to get that long overdue correction, I think this will be the catalyst. Missile strikes on U.S. air bases from Iran didn't do it. The coronavirus was, one day wonder. I said that day. Big deal. We've had SARS. We've had, Asian flu. We've had all these scares before, and that's when that's what the media attributed that drop down on Monday to. And that's what I used to cover shorts and go long, because I said, overdone. It was a technically induced drop. Yes, again, the coronavirus was in existence already, spreading, and a big deal on Friday before that big drop on Monday, and it certainly didn't get any better on Tuesday when we rallied. So again, that's the technicals are playing out here. That's what's working. And again, the news will kind of ebb and flow, and what happens is the market just chooses to ignore bearish or bullish headlines. When the trend is bullish and the technicals are bullish, the market will dismiss bearish news and bearish headlines. Good news is good news and bad news is good news. Likewise, when you're in a downtrend, it's in reverse. Bad news is taken on face value as bad news, and good news is often shrugged off until the charts tell you that, hey, the trend is probably over or close to over. So that's that breakdown. Back test, came a hair above and tighten that trend line up. Yeah, that's a better fit anyway. So you can see now I'm touching the bottom of those candles. I wasn't doing that before. So almost a perfect back test where the body of that candle closed, and rejection. And again, doesn't get much better than that from a technical perspective. Support right here. I'll give you that level right there. You can see some reaction. So here's another one. And again, the point of me doing this video is to make the case that we'll probably bounce here, because this is the first time Facebook's hit that support level since this breakdown. And you can see the reason I added it were all these reactions right here, multiple candlesticks tagging it from below and above. And that was also about the high right here. We had a little candle pop that failed breakout. So I just want to let you guys know what goes into my thought process when I'm drawing trend lines and support levels. I see numerous candlesticks there. That level pretty much stopped all advances. Facebook broke out, but it proved to be a failed breakout. And as I often say, fewer things in trading or investing are more bearish than a failed breakout. Once a breakout fails, what happens is those that took it long realize they're wrong, and they start to get stopped out. And the lower we go, the more selling you get. Shorts are also like sharks. I'm one of them. I'll trade equally long or short, whatever the pattern is. I'm not a perma bear. I'm not a perma bull. But if I see a failed breakout, then shorts smell blood in the water and they pile in, and so that exacerbates the selling. So that's why failed breakouts tend to be pretty bearish events, just like failed in reverse if you have a bearish or a failed breakdown to the downside. And finally, Intel, it's the 5th largest component, so sometimes I'll refer to the FAANGs as the FAAMG+I, FAAMG, I should say, plus I for Intel. Intel, we didn't get the island cluster top or the island top because, see, we don't have a gap yet. We had a gap right here, but we are backfilling the gap, and you get that close to it. Gaps are like magnets. Once they're entered from above or below, this is your gap right here, they're usually backfilled. So Intel is coming up in support, which would be the bottom of the gap, and that would be your next logical support. You also have, there's a trend line there I could extend, and will extend now. We had a little whipsaw move down below right before earnings, so you can see we have intersecting trend line plus gap support coming in together. But yeah, I think there's more downside to come. In fact, I laid out targets Somebody asked on the home page. Again, I encourage you to check the front page posts from time to time, because I'll often go in there if there's a question, or I'll follow up to my own commentary and post additional charts. I posted the other day targets for, no, it was SOXX. Yeah, this is the one-time leverage ETF, and I said I'll try to get to SOXS in a second. Probably confusing you guys. SOXS is the 3-time bearish or short ETF for semis. These are old targets. Disregard. I've not updated these, so don't look at that. Just look at this downtrend line right there. Big wedge. And I will caution you, I like to use the charts SOXX to confirm or really line the trades, my entries and exits, even if I'm trading that inverse ETF. Because the one we were just looking at, SOXS, is a 3-time leveraged. And the more leverage you have on an ETF, coupled with the more volatile the sector, the semis are very volatile, the worse the decay. So what does that mean? It means the charts are going to be distorted over time. Here's an example. You can see my trend line right here on this yellow trend line. That's a primary uptrend line, comes off the December lows in SOXX, which is the non-leverage. This tracks the SOXX Semiconductor index, and we're not yet to the trend line, right? And then on SOXX we are. So if you're watching this and we go up a little, you're going to say, okay, SOXX has broken out, SOXS has broken out, that's a buy signal. Well, you probably jump in the gun there. Maybe it pans out if the semis continue to drop, but you want to be safe. The safe bet is wait for this trend line to break, because this is the index that other one is tracking. They track the same exact index. And so what will happen, a little more upside, you're going to have broken the trend line on SOXS, but you will not yet have broken the trend line on the index itself. And you could bounce off that trend line, because like I always say, support is support unless broken. So there's a little takeaway, and that's why when somebody asked the other day, I laid out these targets here for SOXX. So even if you're going to use the inverse one, SOXS, you want to keep an eye on this one. I like to use the charts of this, again, to confirm or refute my analysis. So that's it. Solid break below that level would be a sell signal, and it is if it comes, when it comes, but remember we have support just below. So it depends what happens if we get a break of that trend line. Here we go, 237.45 is pretty decent support. See, maybe you break down and back test it. Again, how I trade this will all depend on what the indexes are doing at the time. What I mean by that, let's say we break this and the indexes have all just broken good support and there's no support anywhere close below, then we'll probably go right on through 237.45. But if we break this yellow trend line and the indexes like QQQ and SPY hit support, maybe we bounce back and back test it. So a lot of possibilities. And as I often say, the charts are dynamic, and so is my analysis. Meaning the charts are changing day by day, minute by minute, and you just have to see how do things look if and when that trend line is broken. And then here's the additional targets. These are all levels I expect a reaction. 229. Once we get a sell signal, once both of these levels, the trend line and 237.50ish are taken out, targets are 229 and then about 220.34. So, and that would be, I can just tell you right now, my preferred minimum swing target. If this trend line breaks and triggers a sell signal, which I think it will, that would be my minimum expectation for a drop in the SOXX right there. From where we're at today, let me just tell you how much that would be. That would be about 10%. And that should equate to over a 30% move in SOXX. Why did I say over a 30% move? I've talked about that. It's in the frequently asked questions. Go to resources on the top menu of the site. Click on the FAQ to go to the FAQ page. You can then sort those by ETF related questions, and I talk all about decay. What happens is, I know SOXX well, and when it breaks, when support breaks, especially with the market, it's going to fall quick. And in those instances, you can do better than 300% by holding that short ETF, SOXX. It's 3 times leverage. I'll give you an example, and I haven't gone in to verify this yet. Here's a quick drop. What I look for is what I call a unidirectional drop, a pretty swift drop. So there's a 13% drop from the high on July 24th to the low on August 5th, right? July 24th to August 5th. Let me just write that down in case the charts give me a problem here as I jump around. All right, so we go to SOXS, and I go to July 24th. Remember, that's going to be a low right there because we're looking at an inverse chart, 3 times leverage. And that would give you, or gave you, I should say, from the low that day on SOXX, which is the high in the index, 48.73%. So there's a 49% drop against or a 49% gain, I should say, against what did I tell you before? 13%. Okay, 13 times 3 is 36. So you can see that's a big difference. And again, I explained the math. I have to say this over and over again because all I've ever seen out on the web is everybody bashing these 3-time ETFs, saying you're going to lose money. You got to know when to trade them, when to hold them for more than a day or two. In fact, I just got something from one of my brokers, one of the main leading companies that provide these inverse ETFs say they're under attack. It's unprecedented. The SEC is proposing to eliminate these short ETFs, not the leverage ETFs, short ETFs. So they're trying to ban that. At most, what they're looking to do is make it very restrictive, where you have to qualify. You have to prove that you're experienced and qualified to even buy the short ETF. So obviously, I'm strongly against that. I do think there are a lot of people that don't know what they're doing when they buy those, but again, they can be used very effectively if used at the right time. And it all goes back to what I always say: know your security, and know when to trade it. Just because SOXX is volatile doesn't mean if you buy SOXX and you get it in a downtrend, you're going to get 300% or better. What you want to stay away from, I'll tell you exactly where you don't want to own those for more than a few weeks or even a few days. Right here, this is when the decay eats at you in a choppy sideways market. This is when the 3-time leverage works for or against you when you're in a fairly unidirectional trend, either a rally and you want to be long SOXL, or during a sharp correction you want to be long SOXX. Anywhere in between, if the charts are not very clear, if they're indicative that we might kind of chop around or grind around, then you don't want to be in it. If the dam breaks here, as I've been talking about for the last 30 minutes or so, that's when you want to own SOXX. So I'll let you guys decide if you want to do that. And then on the final note, we're going to leave it here. If you do decide to take any leverage ETFs or any inverse ETFs, make sure to factor in that 3-time leverage, okay? And realize what it'll do, because it cuts both ways. If I'm wrong, if you're wrong, and the market reverses and the semis rally hard, a 10% rally in the semis could easily take off 30% or more of SOXX if you're in the wrong side of the trade. So as I always say, there's a position size calculator. You can access it at the very top of the site, that little calculator icon on the main menu, and do the math. Factor in that leverage, and just make sure you don't let those 3-time ETFs or any trade for that matter get away from you. All right, guys, let me wrap it up here, get this out to you, and you have levels to watch. Maybe we'll get some resolution this week, today, but we only have about 3 hours left before the close. My guess is they'll probably keep us guessing today. Maybe break down, but not drop far enough to make it very clear that the markets have broken down. Who knows? But I know this: the markets like to keep everyone guessing, and the other thing they like to do, from my experience, at the time of the big inflection points, think back December 24th, 2018. Let's just say we get a big correction now. What the markets like to do is they're tricky. They like to deny objective entries. What I mean by that? Well, if this whole correction thing's going to play out that I'm talking about, what better way to trap the longs and deny shorts an objective entry than a big gap down on Monday? Because longs, if they have all their stops right below this trend line, a gap down, they're going to get burned. They're not going to. They're going to be filled down where the market gaps to, and so they're going to do. We call those trap longs. Likewise, those waiting to short, but waiting for that confirmation, the trend line to break. won't want to short if we gap down all the way down here to 214 or to 211, and it wouldn't be objective because now you're at support where you're probably going to bounce. So that's why I like to, if the technicals as they are strong enough, I'm going home short as I did last week, last weekend, and I'll do it again this weekend because I think the risk reward is worth it. Yeah, I could get smoked on a gap up. I realize that. But again, that's why I'm also not at a full position yet. If I get an objective entry or add-on on Monday, great. And what would that be? Well, it depends where we break down. Maybe it'll be on a breakdown if it's not too far. Maybe it will be a kickback. Maybe we gap way down and then we snap back up to one of these resistance levels. Again, I'll update that as we go. As I say, the charts are dynamic, so it's hard to say exactly what's going to happen or even close to saying what will happen on Monday. Okay, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Best of luck on your trades.